Hello and welcome to this video on speculation and market bubbles. So in this video we're going to look at the concept of market bubbles and speculation and be able to describe these concepts in relation to market failure. So let's start off with an example. Let's consider the market for oil. Now we know that the price of oil is determined by supply and demand, and the factors that influence the supply for oil, the production costs of oil, getting it out of the ground, and also the availability of the resource, how much oil reserve is there. We know that demand comes from things like demand for petrol and transportation, the demand from things like the production of plastic. And so these interactions of demand and supply cause the price of oil to change. However, what happens when traders stop seeing oil in these terms? They stop seeing oil in terms of the fundamental supply and the reasons why people want oil, and instead see it as a financial asset. What's going to happen to the price? Can I make a profit in the future out of this asset? Well, let's have a look at an example. So, if speculators, people who are concerned with oil as a financial asset rather than to use the oil themselves, see the price of oil rising, they might actually buy more if they believe the price is set to increase. Now this is unrelated to the fundamentals of supply and demand of oil and causes what we know as a bubble, a price bubble to develop. So here over this period of time on this chart we can see a very sharp increase in the price of oil, which can't solely be down to people using a lot more oil over this period or there being a really significant reduction in supply. A lot of this might be down to speculation. Speculators see the price starting to rise. If they believe it's going to continue to rise, then they might buy more now so they can sell later at a higher price and make a profit. When the bubble bursts and speculators feel prices have peaked, they will sell their holdings. The effect of this activity means that prices are far more volatile and don't represent the market fundamentals. So this volatility in price that's caused by this speculation, these bubbles, and when they pop, the crashes, is going to impact the traditional people who operate in this market. So those companies that sell oil, the oil companies, sometimes very high price, sometimes very low price, but also those companies that buy oil, like the petrol companies, sometimes paying a very high price, sometimes paying a very low price. And it's not really related to the fundamental supply and demand of the product. So this can create issues for the normal buyers and sellers in the market. So now let's move on and make some notes. So, speculation. Speculation is the purchase of an asset, a commodity, a good, or often real estate, with the hope that it will become more valuable in the near future. Speculators don't require the assets for its fundamental purpose, but see it as a source of potential profit. Speculators will normally target assets where there is price volatility, where the price can be expected to change. Let's have a look at an example. You see a piece of art priced at $100,000. You believe it's going to become more popular and in the next month the price will rise to $150,000. You don't like the artist, you have no intention of displaying the work. But the question is, what should you do? Well, a speculator's answer would be that they'll buy the piece of art now for $100,000 and sell it in a month's time, making a profit of $50,000, even if they didn't like the artist and had no intention of displaying the work. However, this can become self-fulfilling. If lots of speculators believe that the price of art will rise and start buying this creates an increase in demand, driving up prices. This can create sudden price changes. Now, what might happen in this situation if the price didn't rise the next month, actually it fell to 30,000 euros? Well, you would make a loss, the speculator would make a loss of $70,000. So speculation is a risky business. Now this can lead to bubbles. The act of speculation can cause price to rise rapidly. This price rise is unrelated to the actions of the traditional market participants. So in that previous example, it wasn't related to artists and people who like the artist. In our first example, it wasn't related to oil companies and people who actually need oil. It's to do with speculation, people trading on this asset to try and make a financial gain. And so we call this price rise that's caused by speculation often a price bubble. The price rise is unrelated to the fundamental demand and supply of the asset. So let's look at some examples. Let's start off with housing. Now typically the demand for housing traditionally would come from people's desire for a place to live. It would be related to how much they could afford and how much they would be charged for a mortgage. The supply of housing would come from the cost of building houses and maybe government's regulations over how easy it is to build houses. Through demand and supply, we would get a price. However, we might get a bubble because of maybe perhaps speculative international investors. People may be buying properties in London or New York or Singapore, not to live in, but because they think they're going to go up in value. We also might see companies buying land and not building houses on it, but holding that land as an asset in the hope that it will increase in value in the future so they can make a profit. So here we might see increased demand and restricted supply based on speculative activities. So this might lead to a house price bubble. And in many countries we can see that house prices compared to the average wages of the people who live in those countries have diverged. House prices have got a lot more expensive, whereas wages have remained relatively stable. So we would consider this a bubble. And why would this be? Why would we consider this to be market failure? The market not working very well, because it might result in a housing crisis, with key workers like teachers, nurses, police officers unable to afford housing in a particular area. Let's look at stocks and shares. Traditionally, where does the demand for stocks and shares come from? So buying shares in businesses. Well, we would normally look at it as being a long-term investment by someone based on the analysis of how good they think the company is. If I think it's a good company that's going to generate profits in the future, this will pay me a dividend, so I will buy shares. So there is a demand for this share, which influences the price. The supply of shares is normally related to firms wishing to raise finance, perhaps in order to expand. So the traditional demand and supply here will give rise to a price. However, we may have speculative activity in this market. We might have traders who aren't really looking at the company's finances, but they're looking perhaps at numerical trends. So typically this share price seems to be rising. I don't really know much about the company, but if it continues on this trend, I'm going to make a profit, so I'm going to buy this share. Sometimes we might have computer algorithms that are looking for profit, that are buying and selling shares very quickly based on kind of numerical calculations rather than really what we would call the traditional demand and supply for shares. So again, this can lead to certain issues. This was an event in 2010 known as the flash crash, where suddenly the American stock market, lots of shares in America, suddenly lost approximately 10% of their value on this period midway through an afternoon in the 6th of May because a computer algorithm started selling shares very rapidly based on some trend that it had detected in the market. Now this is causing share prices to move in a way that we wouldn't expect through traditional demand and supply. We might also look at some periods of time where we might notice bubbles rising in the markets. So in the late 1990s, we had what was known as the tech bubble. People investing a lot in technology firms, not really because they understood the companies, but because they felt the price of those shares were going to continue to rise. We might even look at something like Bitcoin today and say that the value of Bitcoin has been influenced by speculative trading. So why does this lead to a market failure? Well, volatile share prices as a result of speculation can influence regular investors' investment plans, so someone who's maybe investing money in shares to save for their retirement, and also can affect managers' performance. Managers are often judged by the share price of their company, and the share price is changing because of these speculative trades. It doesn't really reflect the fundamental manager's performance. Let's look at currency markets. Traditionally, where does the value of a currency come from? Well, it comes from demand for that currency. So consumers and businesses wishing to trade in that particular currency, perhaps because they want to buy stuff from that country. And supply from consumers and businesses wishing to sell that foreign currency, perhaps because they want to buy another currency to buy something from that country. How often? We often get a bubble because we have speculative traders moving money quickly between currencies, and we often have governments intervening in the market to try and protect currency values. So this can lead to countries' currencies being overvalued or undervalued. Now, why might this be considered a market failure? Because we might get very volatile currency values changing very rapidly, or we might get currencies that are very strong or very weak, and really this affects the consumers and producers in that country. So if I'm trying to go on holiday and my currency value is moving very quickly, that's really, the market's not working very well for me. If I'm a producer trying to sell stuff abroad and the exchange rate is constantly changing or is overvalued, again, this is going to make it harder for me to sell stuff abroad and isn't really related to the fundamental demand and supply. It's as a result of these other factors, these speculative traders in the market. So in this video we've looked at the concept of market bubbles and speculation and how these bubbles might lead to market failure. That's it. Thanks very much for listening.